Welcome back. I have 5 dividend stock picks for July 2024. Now, this is just a very quick overview of each one. First of all, Realty Income. I don't think we can go too far wrong with Realty Income. Now, when we look here at the long-term trend, we see over the last several years the price trend has been down, which is in contrast with this underlying orange trend representing the adjusted funds from operations, or more or less the earnings of this company. And that's been steadily trending up, and from here in the forecast area as well, we can see that the forecasts are for a continued uptrend as well, and the dividend payments have been going up also. Now, you could look at technical analysis and say this is forming a bit of a triangle here, but let's look at the fundamental numbers here. Dividend yield 5.64. We see it's increasing. We can see the gap between the white and the orange is increasing with time as well, indicating that the payout ratio from AFFO is improving as well. If we switch over to forecasting, even if I keep this at a 15 times multiple, which is not at all demanding for this company, if the company reaches these expected adjusted funds from operations level at this point in time, we'll be looking at a total annualized rate of return of about 12.3% per annum, which is lovely. Is the company going to reach this? I don't know, but if we look at the analyst scorecard down at the bottom, we can see that both over 1 and 2 years, the company has tended to hit these targets that the analysts are expecting. The expectations have been fairly stable over the last 6 months as well, which is always encouraging. Switching over to ATCO. Now, this is listed on the Toronto Stock Exchange. Now, once again, we can see that while the company in this particular case has had a more lumpy performance history here and with the orange lines, we can see that again prices, just like Realty Income, have been trending down with the higher interest rates after COVID, despite the very strong increase here in the earnings per share for the company. And we can see here as well that the earnings are expected to continue to increase, although at a much slower rate, and perhaps stay steady in 2026. Now, the analyst scorecard is not as clean nor as favourable as it is for Realty Income, but hey, look, I don't think it's too bad. We can see this big gap between the white and the orange line, indicating a nice dividend payout ratio, a very safe one of about 50%. Now, it does have a 5% dividend yield, and if I switch to forecasting, we can see that the dividend growth has been fairly muted in the mid-single digits lately, which is not too bad, but it's not going to grow my account incredibly quickly either. Now, in this particular case, I'm going to switch to the normal multiple for forecasting, a very undemanding 12 times normal multiple, and again, we're looking at about 13% total annualized rate of return, which I think we can achieve. And in particular here as well, we can see that analysts have been revising upwards quite strongly their earnings estimates for the next several years. So a little bit of diversification there, although both of these companies are affected by the interest rate movements. Also, if you're looking closer to home in the US for some utilities, this is, in my mind, one of the nicest opportunities right now. If we look at this chart, we can see again that beautiful upwards trend here for the orange lines. That's what I love to see. We can see at the moment a reasonable dividend yield of 4.2%, and again a beautiful and clean analyst scorecard. We can see prices have been trending down in 2022 to 2024. I'm not too worried about that. In fact, if I take the price off the chart, if I can get this company growing like this at a nice price, I am very interested indeed. So if we look at what's been going on behind the scenes here in terms of the performance, we can see that over the last 20 years, it's more or less just outpaced the S&P 500, but with substantially more dividends reinvested. And that 4% growth has been coupled with mid-single-digit growth, or upper single-digit growth, I think, over the last 10 years, which is looking very favourable. Now, in terms of the forecasting, switching this over to the normal multiple would give us, I think, a little bit of a crazy multiple. But even if we just switch this to a 15 times multiple, we are not going to go too far wrong. Now, this is an incredibly undemanding multiple in my mind. And if we look even at the historical charts, it usually hasn't reached this multiple. You know, it usually doesn't reach this 15 multiple. We haven't seen that in over 10 years now. So even if it wasn't going to reach that multiple, even if it wasn't going to do better than that, we would still be expecting a 6.5% total annualized rate of return. And this is a company, again, where over the last 6 months, the analysts have been keeping their estimates steady and stable. Now, if I was going to be more optimistic, I don't know that I would take a 22 times price to earnings multiple. I think I'd be much more comfortable with sort of an 18 times price to earnings multiple, and that would then represent a total annualized rate of return of about 14.5%. And yes, I realise I'm going over 5 minutes. I hope you can forgive me. Legal in general. Now, this is listed in the UK, so a little bit of diversity there. It is one of the very strong life and health insurance companies. Has a strong market position in the United Kingdom, has a very nice dividend yield. Now, when we're looking at the white line here, the dividends, we are looking in the British system, so a semi-annual payout of dividends. And we can click down here and we can see what that was. We can see the dividend growth rate is mid-single digits as well. So not the best, not the strongest, but when you couple that, I think, with the dividend yield here, that is looking fabulous. Now, if we look at the dividend payout ratio for the 2023 year, we can see the earnings collapse for various reasons. I don't have time to go into here, but they are recovering in subsequent years, and the dividend is projected to continue to increase. So if we take this as the normal multiple over time, which tends to be lower post-global financial crisis for these insurance companies, even here we've got fairly stable earnings expectations from the analysts. We have a reasonable analyst scorecard, although not as clean as WEC or Realty Income. And if this company can hit a very undemanding 10 times price to earnings multiple, which I think is very undemanding considering that we're already sitting above that, we will earn a total annualized rate of return of 15%. That's driven by the good dividend yield, as well as I think the nice and strong, fairly good, consistent into the double-digit earnings growth here that is being expected by the analysts. Now, last and certainly not least, we have UGI. Now, dealing with the fossil fuels, this is an interesting one, and I posted a video a while back and it's gone down since then. Yes, and I will get into a much deeper dive on this company soon. This is, in my mind, certainly a more speculative buy at this point. So in my particular opinion, when you see this sort of divergence occur where prices are declining a long way away from this 15 times price to earnings ratio, that, to me, is a signal that we could be in for trouble here, and we might see these earnings estimates begin to collapse in coming years. So, keep that in mind, interpret this with a grain of salt. But if we look down analyst scorecard, over a 2-year period, they tend to hit the analyst expectations about 90% of the time. So what has it looked like? Well, you've got a 6.4% starting dividend yield. Given the situation here, I would not expect the dividend to increase strongly in the near future. I suspect there are some challenges here that I'm going to get into later. And in fact, here we can see low single-digit growth in the last several years of the dividend. Over the last 20 years, compounded growth rate is lower than the S&P 500, although about 2.5, nearly 3 times as much dividend income being spun off from this as an investment option. So switching to the forecasting, I think here 14.5 times from the historic multiple, I think that's excessive. Here I'm just going to go with the fair value ratio here using the Graham-Dodd formula, and that's suggesting 12.1 times, and if prices return to this, we're looking at a total annualized rate of return of 27%, which, if nothing else, that in my mind is quite high and is suggesting, in fact, that I think there's a much more of a speculative play here. But if we look at the few analyst estimates here for the earnings, they are looking fairly constant and they've been revised upwards a little bit over the last 6 months. although the actual earnings per share have been estimated to be fairly weak overall in terms of these percentage increases of about 2 or 3%. So nothing there, I think, to write home about. And the analyst estimates of the dividends payments, they're estimating that this is going to hold steady, and I think that's reasonable. And again, I'm going to get more into this particular company later on. So what do you think? Are these 5 dividend payers something that you are looking at? Are they on your watch list? Now, if you're looking for higher dividend returns and higher income, I suggest that you watch this next video, because I'm going to look at business development companies and explain why I ditched Main Street Capital for the much higher paying option, and I'll let you know what that is in the next video.